Okay, hey everyone. We have another chat coming up here. A lot has happened since the last time Jean and I got together and talked about the markets extensively. U.S. markets at all-time highs, rates are zero. Government stimulus is since over the last few months since we spoke is massive. U.S. dollar is breaking down. We'll get into that a little more into that later. Inflation is rising. The Fed thinks they can keep it to a 2% target, but who knows? And then we'll talk a lot about what's happening in emerging markets. But let's talk about the two things that are certainly on everyone's mind right now. And Jean, give me your sort of ideas or opinions now. What's happening with COVID, not just in a U.S. standpoint, but globally, how this is affecting now, and how this is going to affect investors going forward.
Yeah, I mean, of course, all of this is related. The election and COVID-19; these are the big things driving the market now. COVID-19, I mean, it's been huge for emerging markets because it's really, as COVID-19 has done in so many areas, so many sectors, it's accentuated trends that already existed. And what we see is that Asia actually has done quite well in controlling the pandemic and in recovering their economies. And Latin America and countries like South Africa and African countries, they've done extremely poorly. And part of that is, I think, homogeneous societies, with strong public sectors and the capacity to organize society and invest in public goods, have done much better than relatively disorganized societies like Latin America and the U.S. today, which has a very difficult time to coordinate any kind of policy and to do anything in terms of the public good. There's so much discordance in the society. So that's a big thing. I think Asia is coming out very quickly and very strongly from the pandemic. So from an investment point of view, that's been positive. So China's been, I think the best market in the year, best market in the world this year. And then markets like Taiwan and Korea and perhaps Malaysia, they're ready to bounce back very strongly next year. So I think and those markets will continue doing well. On the other hand, Latin America, continues to be a disaster. It's been really the focus of COVID-19 really now for several months. I mean, it's been the area of the world with the most growth in COVID-19 and the highest mortality rates. And it's just a huge problem for these countries that already were in very precarious condition. They were starting to come out of the post-commodity boom collapse. They're starting to come out of that. And then COVID-19 has hit and has really hurt the fundamentals quite a bit, particularly for a country like Brazil that finds itself once again with a ballooning public debt. That's going to be a big problem for growth in the future. So I think the growth potential of a country like Brazil has really come down with COVID-19. And then for the other countries in Latin America, we'll see. I mean, we'll see how quickly they'll bounce back. But they've all been they're all coming out weaker out of this crisis. Now, COVID-19 is super important because the whole trade that's been working in all the markets in the world. So wherever you look, technology has been a strong sector. So markets that have big technology sectors like the U.S. and China are the markets that have done particularly well. Now the tech sector has been the big beneficiary of COVID-19 for two reasons. One, they actually benefit from the digitalization of the markets and the economies completely. They're the biggest beneficiaries. Second, the highly deflationary environment that COVID-19 has created has brought interest rates so low, and that's very favorable to growth stocks in general. So COVID-19 is going to be the big issue as we go into 2021. if we really do come up with therapeutics and vaccines, and then all of a sudden we could, there's a lot of pent up demand in all these economies, and then the reflation trade becomes a big issue. You could actually have inflation coming back, a lot quicker than is currently in prices. That's completely dependent on COVID-19. If on the other hand we have a big second wave and we have delays in medical solutions, then the reflation trade is postponed, and we probably have another year of deflation in 2021. So really, that's the key thing. COVID-19 is going to drive it's driven the markets this year, and it will continue to drive the markets in for the foreseeable future.
Yeah, and obviously, along with that, we're we're months away from a big election, obviously in the U.S. Everyone knows, and this is going to be very important for not only obviously the economy for the U.S., but also the global economy, interest rates, the dollar, you name it. There's going to be ramifications. So give me your thoughts more on sort of how it affects the world as opposed to the U.S.
Yeah, it's a tough call because there are two different forces here that that impact depending on what the election results are. Let's say if Trump wins, for example, then Trump, I think it should be bearish for the dollar. I think it's generally bearish for the dollar if Trump wins, because it sort of extends this decline in U.S. exceptionalism and U.S. soft power, and and it will further the deglobalization and isolationism of the U.S. that in general should be bad for the dollar. So it would continue the current trend of dollar weakening. On the other hand, Trump is also potentially a chaotic kind of force. If he continues on the current path, and then that depending on how chaotic things get, then that could actually be positive for the dollar, in that it could create some kind of a risk-on environment. So it's not clear. On the other hand, I think Biden, in general terms, would be more bullish for the dollar, because it would bring back a feeling of American soft power and coordination with with the rest of the world and its policies. And also, Biden actually has a strong program in terms of investments, and which could bring back some sort of real economic growth to the U.S. economy. And the dollar tends to weaken when the global economy is growing more than the U.S. economy. Under a Biden administration, you could paint a scenario actually where very strong sort of public policy intervention in the markets actually creates short to medium term growth. And then the story of U.S. weak growth relative to the rest of the world may not be so true. So I actually tend to think that a Biden victory would be dollar neutral to slightly dollar positive, and a Trump victory could be quite negative for the dollar, and so continue the current trends downwards.
In terms of the dollar and some of the details, obviously, anyone can look at a chart and see that dollar has been breaking down, but it's mainly been weak against the euro and the yen and some of the larger currencies, where against traded with a dollar is sort of stable. And then you have the other interesting thing where you have dollar weakness, but yet EM currencies have not reacted at all. So and then obviously on the other hand, you have the traditional gold, Bitcoin, et cetera, which has done really, really well. So, but EM currencies, and just so give me a little bit of detail about this current dollar weakness. It's been unique.
Yeah, I mean, you're absolutely right. I mean, so far, the market focuses a lot on the DXY index, which is, I think, about 60% the euro and another 20% the yen. So it's an index that's highly focused on the euro and developed currencies. And really, even if you look at the euro and the yen, it's mainly the euro that's bounced back very strongly from its weakness at the beginning of the year. That weakness at the beginning of the year was based on the feeling of a dysfunctional European Union, that the European Union could break up and that the problems could not be resolved. And that actually worked out a lot better than the markets were expecting, right? The agreement that the French made with the Germans, quickly sort of brought things back to normal. And since then, the euro has come back very strongly. The yen has come back a little bit, not as much as the euro. And in terms of emerging markets, since the beginning of the year, emerging markets, I think, are still 3 or 4% down against the U.S. dollar. So while the DXY, I think, is up now 6% against the U.S. dollar, and all of that comes from China. So the yuan is actually strengthened and continues to strengthen, while the rest of emerging markets, particularly markets like the Brazilian real and other Latin American currencies, have continue to be very weak. So it's not clear at all, where we're going from here. I mean, the bounce of the euro, which was caused by the sort of the recovery and the political situation in Europe, that's probably over now. And then, so it's not clear, if we're consolidating at this level, or what will happen next. So it's positive. The emerging markets, they thrive in an environment of a weak dollar, and there's been a lot of optimism on this, but that's not confirmed yet. We still have to wait to see if that can be confirmed.
And the other asset class, which we haven't dived into, is obviously commodities. So commodities and emerging markets usually hand in hand. You mentioned China. Obviously, the stimulus has given a boost to commodities like copper and others. And it seems that on a long-term basis, we all look at the long term, that commodities are now beginning an upturn. But we still haven't seen anywhere near the move to confirm that. But so given that EM outside of China has been weak, the commodities related to China, like copper, have reacted. Give me sort of a more broader idea of what you're seeing on the commodity front.
Yeah, it's the same thing. It's the same thing as the currencies. We've had a recovery from the lows in commodities, and particularly in the industrial commodities that China is a big buyer of. So iron ore and copper in particular. But it's not much broader than that. For the other commodities, it's really, not much has happened. So it's also a trade that needs to be confirmed. It's not, there's not enough evidence here to really get bullish on that. And some of the commodity stocks have done well have also been linked to precious metals, and that's a different trade altogether. That's the deflation trade. It's the reflation trade. Sorry. And it goes with the dollar and the move towards alternative assets as the major currencies of the world, are being debased by their central banks. So that goes for all those currencies. So there is a move upwards in any kind of alternative asset, all the precious metals, the Bitcoin, and to a degree, so that would impact also, all sort of assets in general, so commodities and real estate. So we see that like in lumber prices in the U.S. as well, and so forth.
And yeah, I mean, like you said, I mean, we haven't seen a confirmation of this, but this is all tied in, and it looks like things are turning. So let's change a little gears and talk about emerging market equities, which I think what kind of theme we've always been discussing. instead of asking you if you're bullish or bearish, give us your bullish case for emerging markets going forward, and then obviously your bearish case, and then you can give your opinion. But give both cases so we can see which scenarios make sense.
Yeah. I mean, so the bullish case on emerging markets is essentially the reflation trade, right? But within emerging markets, you have two separate trades. You have the technology trade, which impacts China a lot, but is also having increasing importance in other markets. Even though technology is a very small part of their markets, for example, in a country like Brazil, technology is a very small part of the market, but there's a new generation of investors, that we see in the U.S., where the individual trader has probably the biggest impact on the market that we've seen in decades. I think the individual trader now in the U.S. represents 20% of trading volumes, and as recently as 5 or 6 years, the institutional investors were well over 90%. The individual investor was 5 or 6% of the market. So that's an enormous change. And it's interesting that we're seeing this happening very strongly in many markets. Brazil is a big example of that, where out of nowhere, the individual investor has become a big player in the market. Brazil is a market that for the past decades has been largely controlled. The marginal buyer has been the foreign investor. What we see now is the foreign investor has disappeared, and the markets are driven by individual investors. These are very different investors than your typical traditional investor or your institutional investor. They're typically millennials. They've been attracted by very low trading fees and by online platforms, and they're very tuned in to the disruptors in these economies. So the technology stocks in particular. So a market like Brazil, even though technology is a small part of the market, it's attracting a lot of capital, and it's become a big part of trading volumes. And so that's one trade. If you've done well in emerging markets for the past year, particularly this year, if all you've owned has been technology stocks. So if you were in Brazil and if you had avoided all the traditional blue chips and just bought anything that had to do with technology, you've done incredibly well. China, the same. If you avoided all traditional sectors and just bought technology, you've done extremely well. So that's been the main trade. The other potential trade, which I think is too early and depends a lot, as I said earlier, on the COVID-19 resolution, is the reflation trade, and that's typically the trade that drives emerging markets. So it's a dollar weakness trade, it's a commodity strength trade, and as we just said, we're seeing some small signs of that, but there's no confirmation of that trend. And I think it's still too early. Now, if all of a sudden, we were certain that we had a COVID-19 a vaccine or some kind of therapeutics, and then I think the market will quickly start anticipating higher growth. And with all the pent-up demand we have, we could have a surge in inflation, and then the reflation trade could become a big reality. But we don't know if that's going to happen. And so for the time being, and you can see this in the policy of the Fed, it's very much the focus continues to be on a major deflationary period. And that's not good for emerging markets. So, for the time being, what you should do is you should be positioned in tech stocks, as that trade seems to, have legs. And I think you should slowly start to increasingly position yourself in reflationary trades. So some of those are, for example, the stocks that are benefiting from a Chinese recovery, the big commodity producers, and then eventually start moving into those countries that would be big beneficiaries of a reflationary trade, and those would be the traditional commodity producers like in Latin America, Colombia, Peru, Chile. in the rest of the world, South Africa, Russia, and so forth.
Like we talked about different bullish scenarios you mentioned, but let's do the opposite. What would be the bear case where let's say, would it be the sort of reflation trade pushed out to 2025? What's the bear case for, or a reason you should just stay away from emerging markets right now?
So obviously, if COVID-19 doesn't go away, that will be very detrimental to any kind of growth, and we'll be with very low interest rates for a long period of time. And then the value trade, which is the emerging market trade, emerging markets and value are completely linked, doesn't come back. So that's one bear scenario. I think today, the chances of that are pretty low. I think we will get, some kind of control of the pandemic, over the next year. And then the other sort of, possibility is that the US actually does much better than, what we, think of today. I mean, the current prospects for the US don't look very enticing. They look for, very low growth for the coming years, high dysfunctionality in terms of, the society's ability to solve problems and so forth. Now, if that changed, for example, if Biden won and that he actually showed that, he would be very good at negotiating things in the Senate and driving a new agenda of growth for the US, then all of a sudden, maybe, US growth would actually continue to be superior as it has been in recent years. And then once again, then you go back into this strong dollar, US exceptionalism kind of story. And then, that would extend sort of the, the emerging market, slump. I'm sort of leaning toward, I think this has been a long down cycle for emerging markets. We're going into 10 years now. It's been a long down cycle for an up cycle for the dollar. It's been a down cycle for commodities. Normally these cycles, they don't last much more than 8 or 10 years. So we're due for a whole change in that environment. And I think we're also due for a reflation trade. And so I tend to be, more bullish on emerging markets. I think the probabilities of a bullish scenario working out are higher than of a, continuing bear market in emerging markets.
That way, you have, the realization is that it's hard to believe that the U.S. economy is going all of a sudden just start to just rise again at the historically 2.5-3% level. It just doesn't seem that way, and that's what we talked about, how it being good for emerging markets. I guess the one last thing, if we have a few minutes left here, is talk a little bit about China. You mentioned obviously the currency has been better. The Chinese market has roared back because for a lot of different reasons. And then one thing that I guess everyone knows about that is investing in these on an institutional basis is China. China is a very large percentage of all the indexes. But looking at China, is China, from a valuation standpoint, is China cheap? Is it expensive? Can it continue this run without really, with the economy growing, let's say sub 5%, which is historically the lowest it's grown? So a lot of dynamics have changed in China. So how do you feel about this? Is this a beginning of a bull market, or we're just seeing a blip here?
So to begin with, we have to recognize that the Chinese rally is a tech rally. So it looks a lot like the U.S. rally. It's not quite as narrow as the U.S. market, the FANGs as dominant as they are, but it is pretty narrow, and it's all tech related. So if you include tech if you add to tech also, pharmaceuticals and a couple of other sectors, all those sectors have done extremely well in China. Valuations, are tricky, like they are almost always in tech, because so much of the valuation is based on, optimistic view of the future. And then even more so than in the US, things are more opaque and more difficult to analyze. And these Chinese, a lot of these big Chinese tech companies like Alibaba and Tencent are very complicated. They're black boxes. They have hundreds of investments. So you really can't, it's not easy to really get any kind of valuation parameter. So as long so that's so the Chinese rally is very tied to the US tech rally. So, and then beyond that, you know, China has its problems. You know, everybody's well aware of the problems, and it needs to do several things to, you know, to sort of brighten its future and to brighten the potential of economic growth. And you know, some of that is, you know, control its debt, you know, promote its domestic consumption, but also it needs to really recover sort of you know, a much more cordial kind of relationship, you know, with its neighbors and with the international community. And that's very important for the future of China. If we're going to have a China that you know, increases its role in financial markets, it's also going to be a China that has much lower current account surpluses and trade surpluses. It's going to have to trade a lot more of its neighbors. It's going to be much more of a contributor to global prosperity than a country that's really, you know, benefited more from the global system than contributed to the global system. And all of that, those are all unknown. So we don't know really, you know, it's all very, very fluid at this point. The politics in the US are very complicated. They're very complicated in China as well. And so the future is very unclear. So I think what we can say for the time being is, you know, it's a big tech rally in China. It's become a huge part of the market in China. It's extremely dynamic, and the innovation and you know, it's just as profound as it is in the U.S. market, perhaps even more, because it's probably a more competitive market than the U.S. market. U.S. market's become very oligopolized. It's controlled by a few monopolistic companies. The Chinese market is probably more competitive, and there's probably more innovation. There's a lot more small companies that are being that are innovative because they're funded by the public sector. You know, the public sector is very important in pushing companies into frontier industries in China. And so there's a lot of innovation, and a lot of this is in the stock market now, and increasingly in the stock market, as the authorities have created now, you know, the equivalent of a NASDAQ in China, and the tech sector is more and more important, and so that's what's driving the market, probably for the foreseeable future.
Thanks, Jean. I think you're right. I think that when we talk again before the election, I think the stock prices around the world are going to be significantly different than they are today, but we will see. Anyway, thanks again, Jean, and we'll catch up again soon.
That's great talking with you, Tom.